Sure.
Bill is in Barrie, Ontario. Bill, go ahead. You're on the air.
Thank you for taking my call.
Our pleasure.
I hold Facebook in my portfolio. Could I have David's thoughts on this? Thank you.
Sure.
Thank you.
So look, Facebook is a company we've talked about before as a past pick. At Barometer, we try to focus on secular themes, long-term, not cyclical themes, things that are going to go on for a long time. And we try to buy the absolute leaders in these themes. And one of the key themes is internet media. And whether you're talking about Facebook or Google or something like Amazon, these all fit in this group. Facebook, I think, looks very, very attractive. Obviously, the model is they're selling advertising now. 95% of the revenues come from advertising. They're doing a great job in mobile. They're doing a great job off the desktop. They're doing a great job with things like video. So their user base continues to grow. I think they've got something like 1.7 billion monthly users today. And payments is going to become a business. Today, it's only about 5% of revenues. So look, they continue to execute. The stock is acting well. This whole group of stocks is behaving well. You can buy it on its own. You can buy an ETF, PNQI, which will include a basket of these companies.
Social media
Social media.
Okay.
SOCL is another ETF in this group. I think this is something you really should have some exposure to because this is an almost unstoppable theme in the market.
Okay, unstoppable theme. Yeah, Facebook, it's quite a juggernaut. Neil is in Thornhill, Ontario. Go ahead, Neil.
Good afternoon, and thank you for taking my call.
Our pleasure.
David, I took an overweight position in Cisco Systems a while ago when the Canadian dollar was much stronger, and I see Cisco. But at the time, I didn't see any downside risk, and they were very generous to their shareholders in terms of their dividend. Now I'm looking at Cisco, and it's coming up to what could be a resistance point at over $28. Do you think I should hang on, or do you see it potentially breaking through? I'll hang up and listen to your comments. Thank you very much.
Thank you.
Okay. So Neil, going back to themes, if you like internet, you have to like Cisco. They are firmly at the heart of data transfer across the web and through networks. They are an absolute leader in the group. Their margins have been rising. They've been increasing their percentage of sales that are services, which is a higher margin business, so their margins are going higher. As video picks up in use over the web, they are very important in that whole infrastructure. And frankly, technically, the stock has just made a new high. And so it's broken out to new highs, and I think it looks very, very attractive. So I have no problem owning the stock. We own it in a couple of our funds. And it's not expensive. It trades at about 11 times earnings. So a significant discount to the market. They are committed to returning 50% of their free cash flow to their investors through share buybacks and dividend increases. Dividends grown 19% a year over the last 5 years. So it's pretty hard not to like that. Technically attractive, fundamentally attractive, and a theme that I think is going to go on for a long time.
We have a tweet here from Ron. The question is about Skyworks Solutions, SWKS. Would Skyworks Solutions represent a good long-term semi-play?
So Skyworks is a company that distributes a lot of different components and semiconductors. The stock has not performed well over the last while. I think we got asked about this over the last couple times on. We would prefer to own a company like NVIDIA, where they're firmly in the middle of graphics and video on the internet. Also, though, big into mobile handsets. It's just higher value added product than Skyworks, which is a lower margin product. So I like semiconductors as a group. I like the exposure to handsets. We're going to get a big upgrade cycle at Apple, but I'd prefer something like NVIDIA.
Let's head to Vancouver. Laurie's on the line. Go ahead, Laurie.
Oh, it's Lauren.
Sorry about that.
I was wondering, what's the risk on that Alerion Master Limited Partnership ETF? I can't seem to find anything on it.
Sure. So, Lauren, the Alerion MLP, AMLP, is an ETF that holds limited partnerships, largely energy infrastructure, pipelines, and so on. One of the reasons people invest in it is that they wrap up the requirement for tax reporting, which can be complicated in limited partnerships, into a single reported taxable figure. So that's the attraction. But what you're investing in is infrastructure in energy. Obviously, it's had a great bounce off the bottom. One of the reasons people bought energy infrastructure over the last number of years was because of the large ramp in production and volumes that were coming out of the U.S., and that led to significant dividend growth. Now, given that price now trades for oil is just slightly below the cost of production for most producers, you're less likely to see volume growth, and so that could limit the dividend growth. So the question is whether they can continue to sustain the yield where it was historically. We'll have to see. This is going to be an income name. It's not going to be a growth income name. So you have to look at it differently than you might have 2 to 3 years ago during the oil boom. So the risk is, production is shut in if prices stay low. And so the flows through the pipelines are less, meaning the dividends wind up being lower. That is the risk. And we're going to have to see what happens going forward. I'm not hopeful that the price of oil is going to be much above the cost of production for any length of time going forward.
Okay, we're going to be right back with David Burrows, President and Chief Investment Strategist at Barometer Capital Management, answering your questions on North American large caps, 1-855-326-6266.